we spoke to Peter Marrone, veteran of the industry, executive chairman of Yamana Gold. Now, that company was out of favor more than a year ago over its high debt load. That's after it bought a big chunk of the Malartic mine in Quebec. However, they've been taming that debt. The stock has come back. Speaking of debts and interest rates, we also asked him about this week's surprise interest rate cut by the Federal Reserve. And in fact, Marrone said it shouldn't have been such a surprise.
It's not a surprise that they did, in light of what's happening with the world, certainly with this viral event. But it's not a surprise on a more general, from a more general point of view from my perspective. From my point of view, I think it was an inevitability that at some point the Fed would have to cut. And we've seen it perhaps earlier than I would have anticipated, but gold is reacting positively, as it should. I think it will continue to react well. We're on the front end of a bull market for gold price, where it goes substantially higher than where it is today.
Why is that?
Well, I think if we look at some of the geopolitical factors at play, some of the known events, we've talked about the impact of this coronavirus. We've talked about worldwide interest rates being at low levels with negative interest rates in many parts of the world. Worldwide debt is a multiple of where it was just a few years ago. In the financial crisis, or immediately after the financial crisis, worldwide debt is now a significant multiple to that. Last time I checked, 2 to 2.5 times that. And more importantly, from my perspective, is that worldwide debt is increasing at about double the rate that GDP in the world is increasing. And that's pretty significant. So it seems to me that central banks have to do something to encourage more investment, to encourage some inflation in the world. And in the context of that geopolitical situation where debt is as high as it is, the acceleration of debt levels being at significantly higher levels than GDP, I think it's very positive for gold.
Although gold, of course, is a moving target. Now, right now I'm looking at gold, it's about 1640. It is down from 1672 at the start of last week. Are you disappointed that it's not breaking out to new multi-year highs?
I take a very long-term view. Perhaps I hope I can say that I am a veteran in some respects at looking at markets. And I think that the day-to-day is something for someone else. When I look at it from my perspective, from my lens, I look at the longer-term trends. It's natural for something to correct over a shorter term. But over the longer term, we've seen gold go up more than $320, $330 in the last year. And I think that it has more upside. There will be little blips, ups and downs. That's an irrelevancy if one looks at the longer term.
So your stock as of this week up about 70% in the past year. The gold ETF XGD of stocks up only about 40%. So you're really back in favor. You've managed to reduce a debt load that was worrying some investors.
And understandable that it would worry investors. Gold investing and investing in gold equities is effectively an insurance policy. One wants to know then that the insurer is financially solvent and viable. So it's understandable that one would want to see a better balance sheet. Today we have one of the better balance sheets in the marketplace. Our net debt to EBITDA is trending to below 1. We're at about 1.1 to 1.2 today. And with further improvements on the come on the overall improvement of the debt, while our EBITDA is also increasing. So it's natural that the share price should react positively to that. I don't believe that it has caught up yet. I think that there's still room for upside. If one looks at the multiples that gold stocks, our peers, are trading, for example, to cash flow or to free cash flow, we're still trading at a discount to many of our better peers. With some of the quality assets in the company, I think we qualify as one of the better peers. And so I think there's still a lot of room for upside in our share price.
You've got pretty big production, 220,000 ounces or so in the fourth quarter. Of course, Malartic, that mine you own with Agnico, the giant mine in Quebec, the lion's share, 85,000. Ounces of
yes.
That, yeah. Talk to us about a Malartic. Are you much involved in day-to-day, or how does that relationship with Agnico work out?
Well, it's a true partnership, a true 50-50 joint venture. Not unlike, perhaps by analogy, how we manage other operations. We leave it to the management of the operation to produce their business plans. The most effective way to mine is to ask the management of the operation to say what they can do, rather than corporate office dictating what should be the production level and costs, what should be the cash flow generation. We normally ask our mines to do that. Not different here, except that here, unlike reporting to one corporate owner, they report to two. We provide oversight, we provide advice, but the mine is managing effectively itself.
And then your second biggest producer in Q4 was El Peñón at just under 50,000 ounces. Where is that mine? Just remind us what that one's all about.
So it's in Chile. So it's in the area, about a couple of hours away from Antofagasta in Chile, so in northern Chile. But more importantly than the 150,000 ounces is that it also produces silver. So we produce gold and silver in doré. If I looked at the gold equivalency, treating silver as a gold equivalent, we're producing more than 200,000 ounces per year. What is interesting about Peñón is that it is now in its 21st year of production.
Wow, 21st year.
Yes, and we're still producing more than 200,000 ounces per year, and we have a glide path in front of us, runway in front of us for many more years of mine life. Last year, we increased reserves on gold and silver in the range of 15 to 20% per metal, and that's pretty significant. We increased measured and indicated resources by over 60%. For a mine that's been in production for 21 years, that's very significant.
Because gold mines often don't last that long.
Correct,
yeah.
Yes.
And just finally then, your fourth biggest producer was Jacobina, that complex in Brazil, just north of 40,000 ounces. And a few years ago, or a couple of years ago, people were saying, get rid of that, it's non-core.
Yes, we're so happy we didn't. We had a vision on what Jacobina would be. Jacobina required, you're referring back to roughly 2014.
Okay.
In 2014, it was producing 75,000 ounces per year. It also required a lot of development work to be done. We were also exploring in new areas that had higher grade. We've seen the grade go from about 1.8 grams per ton to 2.4 grams per ton, so a significant increase in grade in that period of time as well. With the development work, with the discovery of new areas that are higher grade, with a better understanding of the ore body, this is a structure that is very similar to what one sees in Western Africa. It's a reef structure. With a better understanding, those three things combined, we've been able to take the production level to about 160,000 ounces per year, but now we have a very modest expansion that takes the production to over 200,000 ounces per year. As importantly, in our view, is the longevity, the sustainability. We see a mine life today based on proven and probable reserves and a very small allowance of high conviction resources of more than 16 years at that production level. It's become one of our more significant mines and one of our better free cash flow generators.
That was Peter Marrone, Executive Chairman of Yamana Gold.